Hey guys, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, if you leave out the first 3 months of 2020, I think the year, in terms of the returns given by the Sensex or the benchmark indices, was one of the best years in recent memory. The Sensex between March 2020 and December was up some 60 to 63%, and this is a very good return if you ask me. Now, I was wondering what kind of stocks gave the best returns when the Sensex was up 62% between March and December 2020. And I tried to figure out the kind of stocks, a group of stocks that would have outperformed the benchmark index by a very good margin between this period. And I divided the stock in terms of their quality. I did not divide the stocks in terms of their market cap or in terms of their size or in terms of their profits, but I used a definition that was so eloquently explained by Warren Buffett in his 2007 letter to shareholders. In this 2007 letter, he classifies businesses, businesses of all kind, into three major categories, and he calls them great business, good businesses, and gruesome businesses. Now let me just spend a minute trying to explain each of these categories. By great businesses, he means that, in fact, he compares these businesses with bank savings account, and he says that a great business is akin to a savings account, is similar to a savings account which pays the highest interest, and the interest rate goes up as the years go by. Now, what he means by this is great businesses are the businesses which pay an interest of 20, 25%, 30% per annum, and they maintain this high rate of interest or even increase this rate of interest, as years go by. These savings account or these businesses are the most capital efficient businesses, and therefore he calls them as great businesses. These are companies which have great competitive advantages, which are run by excellent management teams, which have been around for decades and are expected to be around for decades going forward. So these are the best businesses, and he calls them great businesses. Then he has a second category called as good business, which are not as capital efficient as great businesses, but they are of medium quality. These businesses are similar to savings account, which pays interest in the range of 10, 12, 13%, and where you have to invest some money every year in order to earn those returns. A great businesses are self-sustaining in the sense that uh, they have money to be given out to be paid as dividends even after accounting for growth. But for good businesses, you have to, whatever profits you earn, you have to deploy that back into the business if you have to grow the business, and there is no money to be money left or very little money left to be paid out as dividends. So these are good businesses, great businesses. And gruesome businesses, according to Warren Buffett, are those businesses which are wealth destroyers. Now, this is gruesome businesses is similar to a savings account which pays very low rate of interest. In fact, I think a very good way to define a gruesome business would be to think of a situation where you're borrowing money at 10, 12%, but you're earning just 7, 8% on that money. So you're borrowing at a high rate and earning a lower rate on that money. So for every say 100 crores that you borrow, you would pay 12 crores as interest and earn only 10 crores, which means that you're losing 2 crores in every transaction. If you borrow 1000 crores, uh, you know you would pay 100, 120 crores as interest and earn only 800, or sorry, 80 or 90 crores, and that 30 crore difference is your loss. So these are gruesome businesses as per Warren Buffett, and you should stay away from these businesses irrespective of the valuation they are trading at. So these are wealth destroyers. You should stay away from these businesses, and you should always try and invest in great businesses provided they are available at reasonable valuations. or you can have a look at good businesses, provided again the valuations are attractive. Now, amongst these three kinds of businesses, what is the kind of business that has given the best returns between March 2020 and December 2020? Now, I considered only those businesses for my study where they have generated a revenue of at least rupees 500 crores in the latest financial year, and I found around 950, 960 such companies which were having a revenue of at least rupees 500 crores in the latest financial year, and I considered them for my study. And out of these 950 businesses, uh, uh, top 90 companies in terms of the best quality, in terms of the best ROEs, median ROEs over the last 5 years, I call them as great businesses. And I sort of try to understand the returns that they gave between March 2020 and December 2020. So I shortlisted 20 of the best quality businesses based on their median ROEs over the last 5 years, because higher the ROE, sustainable ROEs, the better is the quality of the business, the better the stronger the moat the company has. So based on 5-year median ROE of these companies, I arrived at the following list. I shortlisted 20 companies, and those companies cumulatively ended up giving 67% returns between March 2020 and December 2020. 67% returns is not bad. I think it's very good returns from a group which is the best in terms of quality. They have the best ROEs, they have strong modes, they have most of the companies have very good management teams running the businesses. So you get a return of 67% from businesses which are defined as great by Warren Buffett. Now let's take a look at gruesome businesses. Now it's pretty surprising. Gruesome businesses which are supposed to be wealth destroyers, as a group, they ended up giving 287% returns between March 2020 and December 2020. In cricket parlance, this means hitting it out of the park. Now, this result is surprising because these are gruesome businesses. These are businesses which has where the business models are broken, where the companies have eroded the entire net worth. They have been raking up losses in recent years, where the balance sheets are leveraged, and still, most of these companies as a group have ended up giving 287% returns. Uh, I think this is pure speculation if you ask me. Uh, you know, uh, I would never invest in such kinds of businesses at any valuations. So even if they have ended up giving 287% returns, as Warren Buffett, is correct in calling them gruesome businesses because they have very poor ROEs, they have high leverage balance sheets. One of the reasons investors, uh, would have made a beeline for these gruesome businesses because they are expecting these businesses to turn around. Fair enough, but according to me, I would not want to pay in advance for the turnaround to happen. I would wait for the turnaround to actually start reflecting in their financials before I invest my hard earned money into them. So, investing in these companies in anticipation of a turnaround is highly risky in my view. And despite the wonderful returns that they've ended up giving between March and December, returns of 287%, I think it's best to stay away from these businesses because these are not businesses. These are not investments. These are pure speculative bets, if you ask me. And you should make speculation, a small, say 4-5% of your portfolio. For the core holdings of your portfolio, I think these businesses are a strict no-no, if you ask me. So despite the 287% returns, I would stay away from these businesses. Now let's come to the great businesses. Great businesses, I think, are businesses which are of average quality, and this group has ended up outperforming the benchmark index, and it has ended up outperforming the great quality businesses, has earned a pretty respectable 131%. Now, sorry, I forgot to mention for gruesome businesses, I considered the top 20 businesses based on their valuations. Though the companies which were the cheapest based on price to book value multiple, the top 20 companies were considered for the gruesome category. And for good category, I have considered businesses which have not recorded uh, loss in any of the recent 5 years, companies which have a debt to equity ratio of less than zero point 0.8 times for the latest financial year. Those companies have been considered for as good businesses in the good business category. And the price to earnings multiple, I have considered between 5 and 9 times, a single digit price to earnings multiple. So good businesses, decent quality businesses, not as wonderful as great businesses, but have decent financials and are available at single digit price to earnings multiple. 20 top 20 of those companies have cumulatively given 131% returns. So great businesses have given returns of 167%. They have managed to outperform the Sensex, the returns given by the Sensex of 62%, but they have managed to do it only marginally. Good businesses have earned 131% returns, and gruesome businesses, which I call speculative businesses, or which I call high risk businesses, they've actually ended up outperforming the others category. They've ended up earning the best returns, a return of 287%. Now, if you are to build a portfolio of 20 stocks, I would recommend that the category, of course, that you should look at is what I call great businesses. But what happens is, most of the times, great businesses trade at expensive valuations. If you think they are great businesses, the market also thinks the same and ends up giving a premium to these stocks. So while it's true that you may not lose a lot of money while investing in a group of great businesses, it's equally true that you may not end up making a lot of money investing in these companies. The reason I said earlier is because the market also thinks these are great businesses, and they always price it accordingly. So unless these great businesses are available at a price to earnings multiple of 20-25 times, I would not recommend investing in these companies. Of course, other people have other criterias. If even if they believe that even if these companies are trading at a price to earnings multiple of 30, 35, 40 times, you should go ahead and invest in them. So as you can see on the chart right now, there's a U-shaped curve, and I have put great businesses in the highly speculative category. I've given them high speculative ranking, not because of the business models. I think the business models are the best, in the best of the lot. They are the creme de la creme of the the Indian corporate landscape, if you will. But the reason they have eye on speculation is because of the price to earnings multiple that they're trading at. As you can see, they're trading at a median price to earnings multiple of 20 times, which I think is slightly on the higher side. Uh, for my personal taste, I prefer investing in companies which may not be great, which may be good businesses, but I want them to be available at very reasonable multiples. So this brings me to the good category at the bottom of the U curve, where the most of the money is made. In terms of investment rating, they're somewhere in the middle. They're not as bad as gruesome and not as good as great either. And in terms of speculative ranking, they are the lowest. And I would like to invest in such businesses, provided they're trading at a price to earnings multiple which is in single digits. A broad thumb rule for valuing these companies is you should have demand at least twice the AAA bond yield in terms of price to earnings multiple. Now, the AAA bond yield in the country, I think, is in the region of 7 to 8%. So you should demand an yield of, uh, you know, 14 to 16 times, which in terms of PE comes to around 6 7 times. So unless the stocks are trading at a price to earnings multiple of 6 to 7 times, uh, they may not provide enough bang for the buck. But once they trade at a price to earnings multiple of 6 to 7 times, and as you can see, they have a decent ROE of 15-16%. The debt to equity ratio on the balance sheet is also low. They are decent quality businesses. So these businesses, if available at single digit P multiple, I think that's where it's a good spot to invest. It's a good valuation to invest, and I think you'll get the biggest bang for your buck here. As you saw between March 2020 and December 2020, these stocks ended up giving twice the returns earned by the benchmark index Sensex. They ended up giving 131% returns, and over the long term period, I think they'll continue to do so. They'll continue to outperform the benchmark index. There will be years where they will not perform, they'll underperform, but over a 5 to 7 year period, I think this category of stocks may end up giving you much better returns than the benchmark index, and that's where your the entire focus has to be. Now, in terms of the gruesome category, although these businesses ended up outperforming the benchmark index by a big margin, but they are speculative in terms of the business model, and therefore I think you should try and stay away from these businesses, because the returns in them, according to me, is more a function of luck than skill. And if you want to try your luck out, you should try that out in a casino and not in these kind of stocks. The key to investing in any, as per value investing principles, the key to investing in any company is try and understand, try and find out, have some rough estimate of the intrinsic value of the company. Now, the business models of the gruesome businesses are so broken, they've been loss making in recent years, that is, it's impossible to get a fix on an approximate intrinsic value of the company. And if you cannot find the intrinsic value of a company uh, to a level where you are satisfied, you should stay away from such stocks. Of course, some of these businesses may turn around and go on to give fabulous returns, but as an investor, I would actually wait for a couple of years for the turnaround to at least start reflecting in the financials, and then take a call. So, irrespective of the returns that these stocks have given, it's best to stay away from them. So, if you are to create a portfolio of stocks in not just the current environment, but all different kinds of environment, great businesses is what you should focus on, provided they're available at a price to earnings multiple which are reasonable, which are at 20-25 times kind of PE. But if a good business at the same time is available at multiple which is a fraction of the multiple that you're getting from great businesses, then you should invest in good businesses which are trading at single digit price to earnings multiple, which, as I said earlier, may provide the biggest bang for your buck over the long term. And this is my personal preference. Your preference may differ from my preference. If you had success investing in great businesses even at high PE multiples, and if you think that's an approach that's more suitable to your temperament, to the way you approach investing, maybe you can try that out. But for me personally, I would prefer investing in good businesses available at single digit PE multiples, and which have strong balance sheets, and which have a minimum revenue profile of at least 500-600 crores. So personally, my preference would be good businesses if they are available at single digit price to earnings multiple. Of course, I'll stay away from gruesome businesses. And great businesses, I may invest in the odd great business if it's available at attractive valuations. So that's all from my side today. Do let me know in the comment section what do you think about this video, and if you like this video, do not forget to press the like button. So till next time, goodbye and take care.